Good evening, everyone. Welcome to this evening's class. How are you guys doing this evening? If you're with me, if you can hear me, just give me a yes in the chat box. Let me know that you're here. All right, I see some hellos and some yeses are coming in. Wonderful, wonderful. Okay. Good evening, Mark. Hello, Kelvin. Hello, Jeremy. Welcome. I see we have quite a few more of you guys here. So welcome to everyone. And this evening, I'll be showing you guys what may probably be one of the most important techniques that you will ever come across, okay? So this evening, I will show you guys how to prepare for tomorrow using what I call 12-12, okay? Now, I know you're probably asking yourself, what in the world is 12-12? Okay, well, 12-12 is basically 12 p.m. Eastern Standard to 12 a.m. Eastern Standard. Now, I think I've told you guys before that time is one of the building blocks of the market. Now, you're probably wondering, how am I going to use 12 p.m. to 12 a.m. to help me in the market? Well, remember that I've taught you guys that the market is impulsive and the market is corrective. The market moves in waves. Now, time plays a very important part of the market movement, okay? So what part of the market is usually inside of the session open to session close? What's usually inside that part of the day is aggressive moves, high volatility moves, which we would look at and consider to be impulsive waves, right? Now, these impulsive waves come from a corrective wave. So it normally will come out of a corrective wave, right? I shouldn't say normally, I should say it always does, right? So it always comes out of a corrective wave. Now, we need to be able to identify these corrective waves. Now, I'm going to use the euro dollar US dollar pair as an example here. I found myself a nice indicator that basically helps me to draw some separators on the chart. So this helps me to separate the time. So you have the white line being 12 p.m. and the black line being 12 a.m. That's Eastern Standard Time, okay? On this MT4 that I'm using, it's going to be 1900 hours as 12 p.m. and it's going to be 700 hours as 12 a.m. This light blue line will represent the 2 a.m. candle, which is 9 a.m. in this case. And this will be the open of the European market, right? So you're looking at European London session open at this time. All right. Good. Now, I'm going to allow you guys to pick a date. Well, you don't have to go back too far because this is not TradingView where I can just enter the date and jump to it. So give me a date and let's start there. Okay. So give me a date in the chat box and let's work with that. All right. Waiting, I'm just waiting for the date. Just give me a date, guys. All right, someone says August 21, no problem. Let's scroll down. August 21, it's not very far, it's close actually. Let's see, August 21. August 21 is, that's Sunday, isn't it? That's a Sunday. We don't trade on Sundays, right? if you look at this, August 21, oh, it's actually a Saturday. So it's a Saturday, so it's not a trading day. Right? So give me a trading day, any day between Monday and Friday. Pick one. 23rd, 19, okay. I saw someone say 22nd first. So I'll go through the dates that you guys gave me. So 22nd, all right. Let's see. 22nd is Sunday. All right, so 19, that's the next option. All right, so we got 19. So we're looking at this piece of price data here. This is August 19. This blue line represents the open of the European session. This white line, this dashed line here represents 12 p.m. Eastern Standard, and this will be 12 p.m. Eastern Standard of the previous day. Okay. So 12 p.m. Eastern Standard of the previous day. And we're going to go to 12 a.m. Eastern Standard of the current day. All right. Now, we will prepare from 1 a.m. Eastern Standard because you need to give price a chance to set up. Okay, you don't want to just come and just draw on the chart. You want to give the price a chance to set up. So you're going to come in at around 1 a.m. Eastern Standard before the European session actually opens and kicks off. Sometimes the session can open with high volatility. So you want to make sure that you have prepared before. Okay, now by doing this preparation, you will be able to know what type of price action to expect. Now, this is a day trading strategy. This is not a swing trading strategy. This is designed strictly for day trading, okay? Now, most of what I'll show you guys is designed mainly for day trading because I am a day trader. I prefer to day trade. Doesn't mean I don't know how to swing trade, but I prefer day trading. So this is what we're gonna do. We're gonna look to see where the market created its swing high or swing low. All right. Now, this is 12 p.m. Eastern Standard, but the market generally closes at 4 p.m. Eastern Standard, right? So you have anywhere between 12 and 4 to see a swing high or a swing low be created. Now, this is going to be the swing that we're going to look at because this is the last swing that we got. If we look at price in real time, it would look something like this. This would be the last swing that we got, this one up here, right? So this is the last swing that we got. We're looking at the last swing first, okay? Good. So what we do is we draw a trend line from the last swing high or swing low, and we're going to connect it to the other swings. And we got this lovely trend line here, right? So this is basically a downtrend. Now, since this is a lovely downtrend, we want to make sure that we draw a line on the next side of this trend so we can create a pattern. Now, this is after price went up, came down. This is the next swing that it created. So this is the first swing to the bottom. So we're going to click on that. That's our swing low. And we're going to create another trend like this. And we're going to try to create this trend as neat as possible. We want to try to make it as accurate as possible. And this is what we have. We have this down channel looking type pattern. Some of us may want to call this a channel. Some of us may want to call this a flag, but I won't look at this and call it a flag because there isn't a lower low in this case, another major low in this case that came before the flag. So this is just a channel to the downside. Now, generally, when we get these types of patterns, what we're going to look for is a breakout to the upside. So this would be a bullish formation, right? Because it's going to say that when price breaks out of this, it should be giving us at least a temporary pullback to the upside or a complete reversal to the upside. Okay. So we're going to look at this as a bullish formation. And with us looking at this as a bullish formation, we are only going to favor trades to the upside because of this formation, right? So price opens at 2 a.m. Eastern Standard. That's where the European session will start. And as you can see, we have this nice green candle and it breaks out of this formation. With this nice green candle coming and breaking out, closing outside of this formation, it gives us a lovely signal to go long. Okay, so we would go long in this case, and we have other strategies that we would use to tell us how far to go. But generally, what I like to do is I go long until I get a red candle, right? So if I get a red candle, I'm going to close out my trade. I'm going to stop trading for the day. Or if I get an engulfing candle. So what I look at as an engulfing candle is after my entry bar, I start with the next bar as bar number 1. And if any candle comes back and engulfs the previous candle, so this is bar number 1. If this one came and engulfed this bar number 1, I would just close out the trade. It means that it's most likely going to be very choppy or it's going to be reversing to the downside, right? So we had an engulfing situation all the way over here. So this is one of the places where we could exit, and this is the next area where we could exit if we're looking at an opposite candle, which is a red bar. Okay, so these are the two things that I look at to give me a reason to exit. And as you can see, I would have been able to catch, let's see how many pips in a case like this if I entered on the close of this green bar. The close of the red bar would give me about 14 pips. Engulfing over here would give me about 15 pips, right? So I'd be making about 15 pips or so for that day, and I'm done, right? So this is, if I'm manually trading this, that's how I would do it. So I would be able to catch my profit and be done with the setup. All right. Now, what happens if we don't have a breakout? All right, now it's going to get interesting. So I'm going to move on to another day. So this was, what day was this? This was the 19th, right? Good. So the 23rd, someone said, let's see, where is the 23rd? 23rd is over here. All right. So 23rd, good. So this is the 23rd, and this would have been the 12 p.m. swing of the previous week, which is Friday, right? So we had this here as Friday, and we had, we created a lower low at the beginning of Sunday, right? And then price started moving to the upside. So what are we going to do in a situation like this? So since this was the highest swing that was created from the previous Friday, 12 p.m., I'm going to look at that, and I'm going to draw my trend line from here, right? So I'm going to draw my trend line from here. Price is moving up. Where is 1 o'clock? Good. So we have 12 a.m. Eastern Standard. This would be the 1 o'clock candle, because this is the area where I'll be coming into the market and looking to draw my trend lines. it's going to give me the most accurate drawing, the most accurate position to place my lines, right? So this would be my first trend line, and you could extend that into the future as well. You don't have to stop. You could just extend it all the way. And my next trend line will be drawn like this, right? From the low, and I'm taking it like that. Okay, so this is an uptrend, right? So this is telling me that I'm expecting that price is going to be progressing to the upside until it breaks out of this trend, right? When price breaks out of this trend, I'll expect that the price would give me a full-on reversal, or it will go into correction. Okay, so what am I going to look for when the market opens? When the market opens, I'll be looking for long setups, because this is a rising flag formation. Okay, so this is telling me that price potentially could be grinding to the upside in this type of formation, and as you can see, it did exactly that. And we would have been able to predict this from this level, from around here. We would have been able to predict that by simply just drawing this trend line in and extending it into the future. Okay, so how would we be able to trade this? When the market opens at 2 a.m. Eastern Standard, you got a red bar, right? But you're favoring longs. So you're not taking any sell setups. You're only going to favor long setups. So when the price comes and hits this bottom trend line, once it comes and hits this bottom trend line and close, once the candle closes, you're going to look to take an entry. Okay, so this is a green candle. It closed. You're going to look to take a long setup. You take a long, it hits the top. You're going to hold on to the trade because you're expecting it to continue to the upside. Okay, now it could break out of this. So you're going to make sure that you hold on to it, because if it breaks out of this trend, you're going to get a nice aggressive move to the upside. So you want to make sure that you hold on to that buy setup. All right. So it hits the trend line. It closes inside. That's okay. It starts to come back. It comes down. It bounces off the trend line, or in this case, it came very close to the trend line and went back to the upside. And as you can see, it just bounced back and forth to the upside until we got to this level. Now, if I'm looking for an opposite candle, this red bar right here is where I would look to exit once we have a close of the red bar. So I entered here, I exited here. The price came back to the trend line. It didn't quite touch it. So most likely I would not take this entry because I did not get it touching. And with it not touching, it could have simply came back and touched on another candle, or it could have simply broke down and continued to the downside, because that does happen in some cases, right? So we know how patterns work. Sometimes they break in the opposite direction. So you want to make sure that you take all necessary precautions. So you want to make sure that it hits the trend line, then close back inside the trend line. Now, once that happens, you can go long. Okay, and it's better if it happens on a red candle. If it's coming down, you get a red candle hit the trend line, you want to go long. As soon as the red candle hits the trend line, closes, then you can go long. You get a better entry. Instead of entering with this green bar is so big, it has so much volume in it, it's all the way up here already. You don't really have much space, right, to be able to catch, you know, a decent move. So in a case like this, you can enter on the green bar if it hit the trend line, and hold on to your trade until you get to the distance that you're looking for. And as you guys know, we use many other methods to determine where we should be looking to exit our trades and so on. And one other thing that we look at is around 12 p.m. Eastern Standard and 4 p.m. Eastern Standard. That is around the time that we're looking to stop trading for the day. Okay, so by 12 p.m., you could get out of the market. If you're still getting a move in your favor, you could hold on to it until you have a reason to exit around 4 p.m. Eastern Standard. But you don't really want to hold trades beyond the 4 p.m. Eastern Standard as a day trader. Okay. So let's see here. Someone give me another date. Let's see what else we got. Give me another date. I see Vernon says days when price is in consolidation. What do you mean by that, Vernon? What do you mean by days when price is in consolidation? Someone says, Mark says the 26th. Let's see. So 26. All right, so this is the 26th over here. And if we were to draw this, let's see here. Let's try to make this look a little bit more realistic, right? Good. Sure. Okay, I think I got it. All right. So if this is the 26th, and we're looking at from 12 p.m. Eastern Standard to 12 a.m. Eastern Standard, right? We want to draw our line at about 1 a.m. Eastern Standard. So we're going to come in at 1 o'clock in the morning, and we're going to look for our highest swing or lowest swing, whichever was created at 12 to 4 p.m. Eastern Standard, right? Anywhere around that area there, that's where the swing will be. Swing low or a swing high. So here we have a swing high. This swing high came in at around 4 p.m. Eastern Standard, right? So this is going to be our swing high. I'm going to use this line here, and I'm going to project this. Let me just extend that. Good. And I'm going to put in my next line. So this is the swing low. Yeah. Just trying to get it as accurate as possible. You want to make sure that you get it as accurate as possible. Okay, it's raid. All right, good. So let's see how this one would have played out, right? So let's see. We're looking to get into the market at, if you're one of those people who want to trade at 2 a.m. Eastern Standard, that's when you want to get in. You want to get in at 5 a.m. Eastern Standard, or you want to get in at 8 a.m. Eastern Standard. You have your options, right? And I did show you guys another method that allows you to use your economic calendar to find where the volatility will be coming into the market. So you don't always have to start trading at the same time every day. Based on where the volatility is set to come, you can position yourself to get into the market around that time. Okay, so here we go. This is the 2 a.m. Eastern Standard candle right around here, right? So this is the open of the 2 a.m. candle. It's a bearish candle, but this pattern is a bullish pattern, right? So everyone knows this pattern is a bullish pattern because it's an, oh, someone tell me, what is it? What pattern are we looking at? What pattern are we looking at? Sandrika says, can you scroll over? I'm going to scroll over in just a while. Jennifer says, descending channel. Okay, I think you meant descending channel, right? It's not necessarily a descending channel. It's an expanding wedge, right? It's an expanding wedge. It's an expanding wedge to the downside. There are many different names traders come up with to call these. Descending wedge, yeah, can be called that too, right? So this is a expanding wedge or expanding descending wedge because it's sloping down. Now, this would be a bullish formation, right? So this is telling you that you should only be favoring trades to the upside. Now, since the market opened, Mark says triangle. It could also be referred to as a triangle. Some traders call it an expanding triangle, right? So different people try to refer to these patterns by different names, but basically they're all the same. So here we got this descending, expanding wedge or expanding triangle, whichever way you'd like to look at it. And it is a bullish pattern. That's all that matters. All that matters is the pattern bullish or bearish? The pattern is bullish. Now, what gets a lot of us confused is we don't know when is the best time to get involved in the trade. And some of us try to go long, we try to go short, all inside of one pattern. Now, I do understand that in some cases, you're looking at a bullish pattern, expecting price to break out to the upside. Sometimes we get what we call a fake out. That's when the price breaks to the upside and then it just fades down, right? So we call it a fake out. It happens a lot. It's just the way the market makers work, right? So basically what we're going to do, we're going to favor upside this formation because it's a bullish pattern. So since the market opened, we got this red candle. We're not going to look to sell. We're going to look to buy. So when this red candle comes and hits the trend line and closes inside of this pattern, we're going to go long. So if we went long around this on the close of this candle, we would have been able to catch the next move to the upside, right? So we would have been able to catch the next move to the upside. And we're going to hold on to it because we want the price to break out, right? So we're going to hold on to it. So it gives us this red bar, and then it gives us this green bar, followed by this green one over here. And this is where it broke out, right? Now, based on the different methods that you're looking at for your exit, you could be looking at exiting the market on this red bar engulfing this green bar, or some of us may look at even this bar over here, but I use another method which I call the bull bear time slot. And this would not be a candle that I would look to exit on. This 12, which is basically 5 a.m., I'll be looking at the 5 a.m. and the 6 a.m. candle for my reasons to exit, right? And if I'm looking at engulfing, it doesn't matter what time it's engulfing. Once it engulfs, I'm going to exit at that time. So over here it engulfed, so that's where I would exit. I would not exit on this red bar because of the method for exiting that I'd be using, right? So this is where my exit would happen, right here. And normally when I exit, if I exit with the engulfing, I'm going to go short right away. Once I exit, I go short. It just simply tells me that the market's going in the opposite direction. So while some of us are only going to be able to catch this little move to the upside, I'm going to be coming in, closing out my buy trade, going short, and catching the next move. So as you can see, the price pushed down. It went down reasonably aggressive, and I would have been able to catch some pips to the downside. Now, remember, we have to use different stop methods for getting out of the market, right? So some of us may look and see that price came back to the trend line, bounced off it. Once it bounced off it, we're going to close out the trade, right? So some of us are going to look at that, whilst others like myself may be looking at the engulfing. So if it came back and engulfed the red bar, I'm going to exit in this area over here. So I would have been able to walk away with a few pips of profit, right? And what time am I going to get out of the market? I'm going to get out of the market if I make a certain amount of pips for the day, or I'm going to get out of the market by 12, or I'm going to get out of the market by 4. It all depends on the volatility that I'm looking at. If I have a lot of volatility, then I'm going to get out when the volatility is over, which is either going to be 12 or around 4 o'clock, right? On days where we have low volatility, then I'd have to be looking at other things that would allow me to make my exit, right? So for example, Let's see where the 12 o'clock is. This is actually, this is the 12 o'clock candle all the way over here. So when I exited here, I could have taken my exit and be done with it, right? Now, we could also look at trend lines. So let's see here. If we were to plot a major trend line, we can use trend lines as well to help us decide if we're going to stay in the market or if we're going to exit. We try to draw the trend line as accurate as possible. It's from wick to wick. Okay, so here you can see when this one came, hit the trend line, closed inside of this trend, I would look to exit, right? So that's one reason why I would look to exit in this area. So that could be my exit for the day. I could also exit and hold on to the next trade, which is long, expecting the price to continue to the upside. But because of the aggressive nature of this move, I'd better be out for the day, walk away with my profit, and be done with it. Okay. Now, what are we looking at for the next day, right? So we have this low, which is the low that we're going to look at 12 p.m. Eastern Standard. This is our swing, right? And we need to find 12 a.m. Eastern Standard. So it's not yet 12 a.m. Eastern Standard, but we could already predict what the move is possibly looking like, right? And we're looking at something that looks kind of like this, right? So far, we're looking at something that looks kind of like that. And yeah, it's going to look something like this. So this is basically what we're getting. And this is a downtrend, right? So this is more or less a downtrend. I would look at this as a bearish formation. So I would not be favoring trades to the upside, right? So when the market opens at 2 a.m. Eastern Standard, I'm not favoring trades to the upside. If the price hits the top trend line and does not close inside of this trend, but closes outside of the trend, then I'm going to hold on to the trade to see if I'm going to get more to the upside out of it. Okay, I'm going to hold on to the trade in a case like that until I find my exit. And once I find an exit reason, I'm going to get out at that point. If it bounces on the trend line, closes inside, I'm going to exit. If I'm in that buy trade, I'm going to exit. Okay. And since this is a bearish formation, I would not be taking a buy trade in a case like that. So when that candle hits the top trend line, I'm going to be looking to go short once it closes back inside of this range. Okay. So that's basically how we'd be looking at the 12-12 method. Give me another date, guys. I think someone said 14. Let's see what the 14 looks like. June 14. Oh, July 26. Okay. Okay, July. July 26th is a Monday, right? So most likely that's going to be a Monday. So July 26th, how are we going to look at this? We have a low from the Friday. So what we're going to do is we're going to, since this is our swing low, we're going to trend this like that. Let's fix this up nicely. Want it to be as accurate as possible. And that is our uptrend. and we're looking for a swing high. The swing high is right here, and one would be right in this area here, right? Let me try to fix this as accurate as I can, right? So this would be one, right? So this is telling me that I'm looking at what would have been at the time. It would look something like this, right? It would look something like this. It's extended into the future. So this would be a bearish formation for me. So I'm only going to be favoring trades to the downside, right? So when the market open comes, you can see here that we had a candle close above. Whenever I have a candle close above or outside of the pattern, I look at the pattern as complete, right? So if the pattern is complete, it would mean that we could be getting a breakout to the upside because price closed above. So we could be getting a breakout to the upside. If it broke out and closed below, we could have been getting a breakout to the downside. Okay. In this case, I'm looking at this as a bearish formation. And as you can see, price closed back above this pattern. So I would not be looking to go short because the price closed outside. All right. So because the price closed outside, I'm going to be looking for another reason to go long because it closed above. So this would mean that if the price pulls back, it could be bouncing off this trend line back to the upside. So here you can see that it closed above, it pulled back, it did not touch, it pushed up aggressively, came back, hit the trend line, bounced off the trend line to the upside. So this could have been my entry to the upside if I took it when price came here. Price did not close close to the trend line, so it would mean that we would have a higher risk on a setup like this, because if you're looking at where the price closed to enter and put your stop all the way down here, you're going to have a pretty big stop, right? So let's measure. Let's see what the stop would look like in a case like this. The stop is about 17 pips or so. All depends on your lot size. This could be a substantial size stop, right? So let me see what events we had on that day. Give me 1 second. Let me just check the economic calendar. All right, so tools, economic calendar. And this was the 26th of July. It's a Monday. Now, when I look at my economic calendar, I'm only looking at high impact news events, okay? So we have some high impact news events coming out of the European market. We have German business climate. We have new home sales from the US. What else we got? That's it basically for the Euro and US. So because this one is starting at 4 a.m. Eastern Standard, as you guys know, I'd be looking at getting into the market at 2 a.m. Eastern Standard. Okay. Make sure the time is right. Good. So 2 a.m. Eastern Standard is where I'd be looking to get into the market, which is on the close of this bearish bar. Now, because we had a close above, it's an early signal to me that the price may potentially be looking to go bullish to the upside, right? So I would not look at getting involved in this trade to the downside. Okay. So as you can see here, price eventually pushed back to the upside and it went up instead of down. And this is still one of those days that I would consider to be very choppy, right? So this is a very choppy day. This is one of those situations that would be better managed by a software. So if you have a software that's coded like I do, I have a software that's coded for handling situations like this. So that is what I would use. My software would take these trades and all I would have to do is simply just manage them out. For example, if I want to go short only, I got a trade breaking out to the upside, then I'm just gonna let the software continue trading from there. The software will manage the trades on its own. It will close when it needs to close, and it will open trades when it needs to open trades because it's coded to handle that type of price action. Okay. The volatility that we're getting in a case like this, it could mean that you're going to have some big stops, and big stops could hurt if they do get hit, but it would be a good situation if the software is handling this type of condition, because in some cases, we may not be proactive enough to take the necessary action. Okay, so this is one that if you're looking to go bearish and you get a close above your pattern, in some cases, it may be best that you just simply stay out of the market. In a case like that, you simply just stay out. Okay. Another way that, oh no, this is the only way that we could have drawn this trend line. No other option in a case like this. Let's look at June 14. Let's see here, June 14. What do we have? Okay, June 14. That looks like it's also a Monday. Okay, so June 14 also a Monday. And we would have drawn our trend lines like this. This is the low. We draw it in like this. And this is the high. And this is one. Draw it in like that. Right? So what we're looking at here is not necessarily a complete pattern formation. So it's not a complete pattern formation that we're looking at, but we would still have a trend that looks like this. Right? So this would be what it would look like by 1 a.m. Eastern Standard. It will look like this. Like it's basically setting up for a triangle type move, right? So now as the market progresses, you can see we got price giving us a red candle. So this would be a nice bearish signal. So your stop would go above the swing or above the high of that bar after you enter. On the close of the bar, the stop goes here. And you can see here the price pushed down, bounced off the bottom, pushed up, and your stop would have been taken out in a situation like that. If your stop is taken out in a situation like that, since you're manually trading, I would say stay out of the market because you're looking for this to go to the downside. Okay, only with software would you be able to handle a situation like this properly. All right, so you can see here the price kind of went to the upside in a very choppy manner actually, and came to the end of the day. And if you're looking at using the different types of exits, you can see here that we have lots of situations. We have a red bar, which is an opposing bar. As I told you guys, I look at this bar for 12 and 1300 hours, which is 5 a.m. Eastern Standard and 6 a.m. Eastern Standard. If I don't see a red bar at that time, I'm not going to exit. The next time I'm looking at is 8 a.m. Eastern Standard and 9 a.m. Eastern Standard. If I don't see a red bar at that time, I'm not going to exit. So these are two red bars that are not coming in at the time that I'm looking for a red bar to exit. So I would still be in these trades until I get a situation. For example, here I got an engulfing bar. This one came, broke the low of this red bar. So in a case like this, I would exit on the break of this red bar's low. So I would be out of the trade in a condition like this. And since this one is kind of going against the pattern formation that I'm looking at, then I would be done for the day. Okay, and that's if we're using software. If we're doing this manually, once I have price breaking above the pattern, I'm not going to bother getting involved. I'm just going to leave it alone, move on to the next day. Okay. All right, so let's see here. What else we got? Someone wants to see the 12th of August. Let's see here, August 5th, 12th. Okay. So what are we looking at? This is basically August 12th. And let's see here. This day looks very choppy. So this is the 12 p.m. swing. And I drew this trend line like that. And this is the low. Drew the trend line like this. Make sure I get it the right way. Good. Good. So this would be the potential pattern that I would be looking at, right? I'll be looking at this as my potential pattern. Actually, no, not this one. This one is incorrect, right? Because this one came down. It came down and this is the swing. It ended here with this swing, right? So because it ended here, this would be my first line that I drew. And my second line that I would draw would be here, like this. So this would be what my pattern looks like. And as you can see, this would be a bearish pattern formation, right? So this would be telling me that I'm expecting the price to go down, right? Now, the market opened here. It opened with a bearish candle. So if I'm looking at getting involved with a sell trade, this would be a nice signal for me. The price hit the bottom trend line, bounced back to the upside. So since it bounced back to the upside, it hit the top trend line and it bounced back to the downside. Now, with it bouncing back to the downside, this is where you want to go short again. So if you took this short, you want to go short here again, right? So you want to go short here as it comes down. When it hits the trend line, you're not looking to exit when price hits the trend line. You're looking to exit when you have exit conditions being met, right? So let's see here. This candle is 1400. This candle is 1500. So if this candle came and closed green, 1500, I would exit in this area. So this would be a candle that would cause me to exit because it's a green candle coming in at 1500. And so I would exit this trade. Okay. So I would exit this trade and I'd be done with it. Now, if you're using, let's say, market geometry, you'd be measuring the impulse. Let's take off the array and you'd be projecting this like that, right? So anywhere around this level is where you'd be making your complete move so that you can exit the trade, right? So if you use market geometry, it'll give you a nice area where you can exit. If you're using any other stop exit methods, those would also give you good reasons to exit. Market geometry is very effective. So you can use market geometry to help you measure your waves, especially when you're in a corrective cycle. So when you're in a corrective cycle, using market geometry would help a lot to find where your exit should be. And in this case, it would have been around this level, right around here. Right, so anywhere around here, we could have exited and be done with this one. And as you can see here, let's see, around this time here, where price starts to go back to the upside, it approaches 12 p.m. Eastern Standard. So around this area, you definitely wanna exit. You don't really want to be in the market at this time. This is 4 p.m. Eastern Standard. Definitely at this time, you don't want to be in the market either, right? So you want to get ready for the next day. So in this case, the next day would be the 12th. Let's see here, when's the next day? 13th, right? So the next day is the 13th. And you can continue trading the next day because you may have a better setup. So this is your swing high, and you connect it like this. And this is your swing low, and you connect it. In this case, it's going to be like this. Let me see here, 1 second, good. So in this case, it's going to look something like this, right? So you have your highs connected, you have your lows connected, and it's going to look like this. So here you have, this would be a bullish formation. So you don't want to be looking to sell on this bullish formation because, as you can see here, you have a push up. So this is your impulse, and this is what you're expecting your correction to look like. So if this is a bullish formation, we're only looking for bullish trades. We're not looking to go short. You're only looking to go long, right? So in a case like this, if you're looking to go long, then what you're looking for is a green bar. So here you have an engulfing situation between this green bar and this red bar. This green bar came, broke the high of that red bar. So in a case like that, I'd enter on the close of this green bar. So if I entered on the close of this green bar, as you can see, when price hits the top of this pattern, I am not going to exit because it is a long bias pattern. If it was a short bias pattern, when price hits, if it closes back inside of the pattern trend lines, I'm going to exit. But in this case, it's a long bias pattern. So I'm going to hold on to the trade, see if I get the breakout. And in this case, you can see that we got the breakout. And let's see here. This is a 1300 candle, which is basically 6 a.m. Eastern Standard. So this red bar would be a reason for me to exit, right? So on this day, I would have had this red bar tell me exit. If I'm looking at other methods, then I could be using market geometry. If I want to use this leg, I can measure this leg and I project this from here. And my next exit would be somewhere around this area here, right? So this next red bar would be a place where I'd probably want to exit my trade, right? So that's also something to look at. You also need to pay attention to what's happening on the economic calendar. So let's take a look at that economic calendar again for the 12th. All right, so that's the 12th of August. Let's see here. 12th of August. We have 8:30. Yeah, so that's all we have. US news coming in at 8:30, which means we should have been getting involved in the market at basically between 12 and 1300 hours, right? So let's see, where would that be? 10, just 12. So somewhere around here is where we'd be looking for our entry, right? Now that's if I'm using my software would be able to look for this entry and get involved. Also, if this was a Friday, which I believe it is, let me just double check the day. Is this a Friday? Oh, this is a Thursday. Okay, so since this is a Thursday, my software will be looking to get into the market Let's see this. Yeah, right around here is where I'd be looking to get into the market. And most likely my software would have been able to predict, or sorry, not predict, would be able to detect this entry. It would have been putting me in a sell. And once that sell did not go in my favor, it would have taken the buy and most likely be able to catch the next move to the upside. And once it catches the move to the upside, it will be looking for a reason to exit, which would most likely be an engulfing or an opposing candle in my, what I look at as my bull bear time slots and so on, right? So this is one that would have been great. If you're using the software, would have been lovely. If you're using manual approach, then you could have been using market geometry to measure your distances so that you can decide where you're going to look for your exit. You could use Fibonacci. A lot of traders like using Fibonacci. So you can use a lot of different methods to help you predict where you want to get out. Okay. Any questions so far? Any questions so far, guys? All right, I think this is Sandrika. Yes, Sandrika says, what software are you referring to? It's a trade assistant software that I'm putting together to be used with prop firms. So some of you who were available in the prop firm group when I mentioned it, that's what I'm talking about. So hopefully it will be made available to you guys in the near future. Hopefully, keeping my fingers crossed. And we'd be using this method to help us filter out trades that are not in our favor. All right. So that's it for tonight's class, guys. This brings us to the end of this evening's class. Thank you so much for coming. It's been a pleasure as always having you. Thank you so much. You have yourselves a wonderful evening. Okay. I'll see you guys on our next class. Bye-bye.